Hello, everyone. My name is Joshua Mintz, and I'm the product lead for investment banking and private equity solutions in APAC. And today I will be joined by my colleague Clement Ma, who is the overall lead for product in APAC, excluding China. The last few years, we've been presenting the data against an increasingly tenuous backdrop of geopolitical forces and risks of a global slowdown. And we've always been able to highlight some aspects of resilience in the market and reasons for optimism. And against the current backdrop of the COVID-19 pandemic and geopolitical brinksmanship, happy to dive into the numbers again and take a look at the impact on deal activity. So reflecting on the first half of 2020, which is thankfully now behind us, there are various themes that continue to shape deal activity. Activism has emerged at a rapid pace, including through the pandemic period. But how successful have these efforts been? COVID-19 has fundamentally changed the way we live and work. How has that affected tech M&A and technology investments? 2 years ago, Clem and I gave this presentation, and we were cautiously optimistic that the trade war would find a not too far off resolution. As the stakes have evolved and geopolitical pressure now ratchets up, what has come of the phase one trade deal? And while money continues to flow to private markets and long-term story remains promising, how has the near-term outlook been affected? And when it comes to IPOs, will APAC and Hong Kong in particular be able to maintain its seat at the table? To start things off, I'd like to provide some perspective on the performance of the financial markets. This slide shows index performance since the start of 2019. The colored lines represent the associated indices on the right, with the S&P 500 in orange. And so very quickly, we can see both the S&P 500 and the Shanghai Composite in dark blue have outperformed the other regional indices. When we look back at Q1 of this year, we see that the Shanghai Composite did not experience the same dramatic fall as the other markets. And though the S&P 500 is the top performer during this period, the recovery is rather tenuous, with a K-shaped recovery where a few key constituents and industries are driving the growth. And looking towards the other notable performance, we have the Singapore Straits Times, down over 21% in 2020 up until August 31st. But there is potential upside here, given the cyclical nature of the financial and the real estate constituents. After seeing the recovery in the stock markets of China and the US, I'd like to touch on the phase one trade deal. As you may have heard in an earlier presentation, our Panjiva research team has identified US-China trade relations as a central part to the forthcoming US elections. Panjiva's data can be used to analyze the impact of the trade deal signed back in February and its potential success or otherwise, as we'll soon discuss. On the chart on the left side, we have US exports of the 548 products denoted under the phase one trade deal to China. Dark gray represents manufactured goods, red agricultural products, orange energy, and gray as services. The cross-diagonal bars represent the trade purchases allotted under the trade deal. And so what we can see here is that the purchases are actually quite far behind the target for both manufactured goods and energy. Agriculture is actually performing better than depicted here, as this data represents shipments and doesn't account for forward contract purchases. And so looking towards the semiconductor chart on the right, we have China denoted in blue and Hong Kong in pink. The columns represent monthly export shipments from the US, and the lines represent the 3-month moving average. And so what we can see here is that though the trade war and the placement of Huawei on the entity list impacted China's semiconductor imports in the short term, they've actually recovered, and the 3-month moving average is actually at an all-time high, though this is likely the result of stockpiling due to the all-out ban for Huawei. And so against the backdrop of the pandemic crisis and the severe economic downturn, which have been contrasted by the strong financial market recovery, another perspective we thought that could be interesting is how analysts have reacted within their stock market recommendations across these markets. This chart represents the percentage breakdown of aggregate analyst recommendations over time. The dark and the light green colors represent buy and outperform recommendations, with the columns representing yearly time periods up into the first half of 2020. And so the first thing that jumps out here is really the positive outlook when we look at China's aggregation at 52% of recommendations rated as buy. And really, this aligns with what we saw on the previous slide, where the Shanghai Composite Index was battling with the S&P 500 for the top returns. On the other side of the coin, we have Singapore and India, which have experienced declining buyout perform recommendations, with India being the most pronounced. But overall, despite the pandemic and economic uncertainty, it doesn't appear that the analysts have meaningfully adjusted their outlook on public companies yet. And so shifting gears, I'd like to cover recent trends in M&A and private markets. Looking towards global M&A activity, we can see COVID's impact on deal making. The charts are color-coded with North American dark gray, EMEA in red, APAC in orange, and LATAM in light gray. And we'll be using these color codings throughout the presentation. Starting with the aggregate deal volume chart on the left-hand side for the first half of 2020, Globally, on an annualized basis, we are down from last year, tracking about minus 13.8%. APAC is the relative bright point, down on an annualized basis of only 7.7%. Covering the other regions, LATAM is down by 21.9%, followed by EMEA at minus 16.3%, and North America down 15.1%. And then if we draw our attention to the chart on the right-hand side of the screen, we have aggregate deal value. And here's where we're seeing the drops much more pronounced. Globally, values are down 40%, but from a regional standpoint, there really is quite a disparity here. North America saw the biggest drop by far, down by 60.7%, followed by LATAM, down 42.9%, and EMEA, minus 35.6%. But when looking to APAC, again on an annualized basis, we actually do see small growth at 0.34%. And with the impact of the pandemic on M&A in mind, we thought it might be good to look at how activist investors has responded. And we focused particularly a lens on Japan, given the emerging role of activism in recent years. And so looking at the chart at the top left, since the launch of the Stewardship Code and the Corporate Governance Code, we've seen a rise in the number of campaigns targeting Japanese companies, though with varying degrees of success. Q2 of this year was a record, with 68 activists launching campaigns as investors seek increased shareholder returns, either through dividend increases or share repurchases. And as we examine the chart at the bottom left, highlighting the successful campaign, we can see that the majority of these actually related to M&A, with the industrials and consumer discretionary industries being the most targeted. And when we look at the table on the right, focused on the largest campaigns, we can see there's actually quite the potpourri of issues that have been raised, which include third-party successful bid of Sony Electronics Corporation's spinoff and Elliott Management's successful bid at SoftBank to add more independent directors and the creation of a compensation committee. And looking briefly towards global peers, there are a couple key takeaways here. Firstly, starting with the table at the top, success rate. Activists in Japan have thus far been less successful than their global counterparts at about half or even a third of the success rate. This is not necessarily surprising, as activism is relatively new in Japan, and there will be an adjustment period. Secondly, I'd like to draw your attention to the graph at the bottom and the 2020 figures on the right. We're only halfway through the year, and we can already see that this is on track to be a year of heavy activism, with the US at nearly 500 campaigns launched as investors take advantage of weakened share prices. And so shifting gears once again, as we think about demand pull forces driving M&A, we're excited to include this additional lens that comes from our recent acquisition of 451 Research, which focuses on emerging technology globally. And so on the left, when we look at global M&A deal counts, they're very clearly linked to specific technology themes. The largest categories near the top are really the ones that you would expect. Software as a service, machine learning, Internet of Things, really all tied to that strong growth around cloud computing. And then on the right-hand side, we look at recent survey results from corporations relating to COVID-19 and its impact on upcoming tech investments. And there are a few quick takeaways here. On the top, if you focus on the orange bars, we can see the larger percentage of APAC respondents at close to 16% expect to actually increase spending across some key technologies like collaboration tech, info security, and mobile. And on the bottom chart, we see COVID's impact on digital transformation initiatives, and with the outer ring being global respondents and the inner ring reflecting APAC respondents. And really there's a more mixed result here, with a higher percentage of APAC at 26% in light green saying they plan to accelerate digital transformation, but also a higher percentage, again at 26% in light pink, saying they plan to delay their timeline. But overall on this slide, we can see the forces of technology continue to drive near and longer term investments. And so focusing more on private markets, through our recent partnership with Preqin available via data feed, I'd like to discuss the record amount of dry powder in the market. At the top chart, we have yearly dry powder based upon fund manager location in billions, where the width of the circle represents the aggregate dry powder. And really two things jump out here. First, looking at the gray circle, the tremendous size of the dry powder in North America, growing by over 650 billion in 5 years to 1.6 trillion as of August 28th. And two, the strong growth on a CAGR basis when we examine APAC in orange, where the region grew by 24.2% since 2015. Then if we focus on the bottom, we have the number of funds closed in a given year, denoted by columns and using the left-hand axis, and we have the average fund size represented by lines and using the right-hand axis. And what I think is really interesting here is that even with the effect of COVID, even North America funds have managed to grow an average fund size, while APAC has decreased. And so after going over the dry powder available globally, let's look briefly at how much is being deployed from a deal value basis. The top chart shows PE VC aggregate closed deal values by target region, And again, we are seeing a consistent theme here when we analyze the numbers, with North America in gray having the largest decline at 20.5%, and APAC in orange actually showing modest growth at 5.7%. On the bottom, we have our familiar color coding of markets. And looking to the right for the 2020 first half, we have a bit of an uneven distribution, with China continuing a downward trend in closed deal values, and Japan a relative bright point, where we have already surpassed the 3.6 billion deployed in 2019 to 7 billion in the first half of 2020. And lastly, before I turn things over to Clem, I'd like to talk about some of the results from our 2020 private equity mid-year survey. Over 4 weeks this summer, we surveyed 142 unique PE firms across the globe on a number of questions, and I've included 2 today to discuss. The top 4 pie charts represent aggregate regional response for the question, how much do I expect the investment activity in my location to slow down in the coming months? Light green represents a flat or increase, yellow a decrease of less than 25%, pink 25 to 50, and red a decrease of greater than half. And what's interesting to see here is when we look at the APAC pie chart at the top, we have a dichotomy where 40% of respondents indicated no change or an increase in activity, but we also have 40% of respondents indicating a decrease in activity of 25% or greater. If we now focus on the bottom half of the page, we have the question, what has been the biggest challenge faced at the portfolio company level during COVID-19? For APAC, which is denoted by the orange bars, liquidity concerns and supply chain issues were the biggest, each indicated by 32% of respondents. And so finishing off with this survey-based outlook, I'd like to now turn things over to Clem to walk through the IPO landscape.
Thanks a lot, Josh. So last year, when we looked at IPO markets, a big question was whether or not Hong Kong could retain its crown after a strong 2018. We saw the $11 billion Alibaba listing last November, and that was enough to put it back on top. And so now, against an even more challenging backdrop, including pressure on Hong Kong's role as a global financial center, we're still asking the exact same question. So if you look at the faded bubbles in the background, you can see where the global stock exchanges ranked in 2019 on IPO volumes. And then if you compare it to the darker colored bubbles, which represent IPOs completed in 2020 through to June 30th, we can see that Hong Kong in pink is still a contender at close to $11 billion raised. Where we've also seen movement is the New York Stock Exchange in light gray, which sits at the top spot in 2020, and that's supported by record listing activity for SPAX, which are special purpose acquisition companies. And then, of course, the Shanghai Stock Exchange in dark blue, which is significantly outpacing 2019 levels with strong momentum from the Science and Technology Innovation Board, the STAR Board. And so when you roll it up, all these fragmented markets in APAC, it is a sizable number. We can see the impact here in terms of the regional breakdowns. The top chart focuses on IPO deal counts. The bottom chart focuses on IPO deal values, and we see APAC exchanges captured here in the orange bars. Overall, especially as we look at the last few years and the top chart, we've seen a significant volume of IPOs coming out of the APAC region. And since 2015, APAC has led the charge each year in both deal counts and deal values. As expected, given the tough market backdrop in the first half of the year, overall IPO volumes have trended downwards. But if you annualize APAC's first half, it represents a decline of 23% on a deal count basis and 17% on a deal value basis. This slide looks at the largest IPOs globally. So in 2019 on the left-hand side, and then 2020 on the right-hand side. And the color coding represents exchange geographies. And we specifically call out China and Hong Kong separately in dark blue and pink. We also use the striped coding to indicate those that relate to new market listings, as some of the largest deals in the past 2 years relate to US-listed Chinese companies seeking a backstop listing closer to home. So far, we see China and Hong Kong near the top end of the table across both time periods. As we look at the distribution and the size of the deals in 2020 versus 2019, this no doubt reflects the delay of IPO plans earlier in the year due to the pandemic. In fact, looking into the details of the top 10 deals in 2020, 7 of the 10 deals were completed in June after the market had rebounded from the earlier lows. And then beyond the 630 cutoff of the slide, as markets have continued to get better, we've seen a $4 billion SPAC and 4 other completed IPOs that would have made the top list for 2020. So we highlighted earlier the challenges facing Hong Kong on the back of the geopolitical forces and the rising competition from the Shanghai Star Board. And this slide here captures it in more detail. So at the bottom of this page, these bars are the rankings for the top global exchanges by deal value, and it's sorted by the 2018 numbers, where Hong Kong was also the #1 exchange that year for IPOs. On the bar chart at the top, we highlight the monthly deal activity over the past several years, including some of the large deals driving those results. So in 2018, it was Xiaomi, China Tower, and Meituan Danping. And then in 2019, the big contribution of Alibaba. Focusing on 2020, we see that Hong Kong has again had a slower start to the year, but we did see contribution from the 2 large backstop listings in June from JD.com and NetEase. And we also have the upcoming Ant Group IPO for both Hong Kong and Shanghai that will help move the needle. So this slide recaps the recent actions of exchanges and regulators to position for the lucrative tech and biotech IPOs that continue to emerge. It's beyond the period of this timeline, but for the context of the chart below, it's worth reminding that back in April 2018, the Hong Kong Stock Exchange announced rule changes around dual share class listings and pre-revenue biotechs to specifically target the biotech segment. In this timeline, it's also worth focusing on the Star Board, which was officially launched last June with the goal of supporting the growth of domestic tech firms. So if we shift our attention to the charts below, starting with the left, we can see in pink the immediate impact of the Hong Kong biotech rules on biotech activity. Prior to the rules in 2017, you could see that Hong Kong's share of the APAC biotech market was 35%. And then following the rule implementation, we saw the increased proportion that Hong Kong represented in the biotech space. But then it's also worth focusing more recently on the dark blue bars, where we see that the Star Board has now become a meaningful competitor for biotech activity. And then on the right-hand side chart, this highlights the universe of global tech IPOs and where they have listed by region, with Hong Kong and the Star Board again captured in pink and dark blue. I think the point here is that we see a lot of swings, especially between APAC and the US, and we should expect that trend to continue with the pressures to win in this tech space and also the rising risks of geopolitics and technology decoupling. This slide looks at how the recent IPO market has performed and focuses on IPOs completed in 2019 through to June 30th this year. The vertical axis represents stock price return percentage from the offer price through to August 31st. And then the horizontal axis represents the IPO offer date. The size of the spheres represent the relative size of the IPO in US dollars. So there's a lot of data points here. And we have called out some specific data points for reference. On the top left, the incredible 900% plus return on Zoom. The largest bubble in the middle, Aramco, up 11% from its IPO. And then at the very top, from APAC in orange, we had several tech IPOs up more than 1,000% from their offer price. Zooming a bit further into the performance and how it cuts across different markets, this slide focuses on just the 2020 listings through to June 30th, and again, calculates performance up to August 31st. The leftmost chart looks at just the Chinese exchanges, so separating out the Star Board in dark blue from the main boards in light blue, and we've calculated the average returns for both groups. As expected versus the rest of the world, the Star Board, with its tech-focused universe, has strongly outperformed with average returns of 195%. But then it's also worth pointing out that the main board averages an even higher 250+% return, although it is a much higher standard deviation and would end up lower on a market cap weighted calculation. Across the other geographies, APAC ex-China comes out lowest with an average performance of 40%, whereas the rest of the world comes out at an average of just above 100%. I touched on earlier the contribution of SPACs, which are essentially blank check acquisition funds. This slide looks at historical SPAC IPO activity up until June 30th, with deal counts on the left and then deal values on the right-hand chart. So looking specifically at the deal value chart on the right, it was already 17 billion through the first half of 2020. But what's even more remarkable is that we ran the same deal screen a few days ago, and that amount raised has almost doubled to 32 billion since then. So it's already a record year, and there's still a lot of optimism around continuing SPAC activity based on the heavy pipeline of tech and growth companies with high valuations that are seeking an alternative to IPOs. And looking forward a little, this slide is for illustrative purposes only. It highlights the potential landscape for future IPO activity based on potential IPO and listing announcements and news coverage captured within our key developments database. This data is based on 2019 up until August 31st, where we flagged potential IPO-related key developments. In this reverse pyramid chart, we also indicate in light shading those key developments that have already led to completed IPOs, and then the ones that are remaining in the pipeline. Overall, APAC is the largest contributor in this study, which is consistent with its larger IPO volumes that we've seen in recent years. As we look forward, I think the key takeaway is the rising optimism around the upcoming IPO pipeline, both in APAC with the mega IPO from Ant Financial and the continuing momentum we've seen with the STAR market, and then also in the US, where there's been a deep tech pipeline of IPOs like Palantir, Airbnb, Snowflake, among others, that are now firming up their plans to go public. So to wrap up, there's no end in sight on the geopolitical tensions, and we've highlighted the not unexpected drag on both M&A activity and IPO activity from the current pandemic environment. But against this backdrop, there are themes that continue to be relevant and will drive deal making. Investor activism has been an emerging force for change in Japan and globally has picked up coming out of the peak of the crisis. Trends in technology, in some cases accelerating on the back of COVID, will continue to be a driver of investment and deal strategy. With private markets, dry powder continues to build, and there's some optimism in APAC around an increase in investment activity in the near term. And then Hong Kong continues to attract key IPO listings against a rising challenge from the STAR board. And overall, globally, we see technology and growth companies continue to fuel the IPO pipeline.